Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host for Upticks. Today is our 69th episode, Making Big Bets. All right, Cory, welcome back to the show.
Thank you.
You're becoming a regular again.
It feels good.
For today's episode of Upticks, we wanted to talk about making big bets. And really the point of this is that the market has run up over 20% as of the recording of this show. We'll be rolling this show out in December, so we're, barring something catastrophic happening, we're going to end the year up far above the typical average, which is around 9%. And so I wanted to talk about, what do people do? Do they roll the dice and keep their money aggressive, or do they go buy more stocks? Or is now the time to take some money off of the table, get a little bit more conservative, and bank some of those profits? But before we go into what we think a prudent client should do, I wanted to also talk about sports gambling, which has been legal now for about a year and a half. And I wanted to know, have you indulged?
I've not.
So neither have I. And I think as far as Kansas City is concerned, I don't think it's legal at any of our casinos. But I know maybe on the northeast area of the United States, I think it is becoming more standard and more legal. And I'm just curious what that's going to do to sports ratings and everything associated with that. So again, it's pretty fascinating to me that they've legalized that, and now they're looking at paying college athletes. So it's pretty interesting from when I grew up, where betting, you had to have some sketchy bookie, and certainly none of the college athletes were paid, and most of them played in college for 4 years before they went on to the pros. And now you're seeing these one and dones, they want to pay them, and then there's sports betting now. I don't know, what's the next 20, 30 years going to look like?
I don't know. I suspect marijuana is going to be legal in all 50 states. That's one thing that, 20 years ago, maybe it would have been very taboo to think about.
Right.
But that's sort of the direction things are.
Yeah, so it's pretty crazy. So whether you like it, agree with it or not, in the end, it's probably all about money and the revenue that the states can generate from allowing these things.
100%.
I don't encourage sports gambling, but also I get it. If you want to put $100 on something and that makes your heart pump a little faster or get you going, then sure, as long as you don't disrupt your financial plan,
of course,
or your retirement plan.
If it's part of that entertainment line item in your budget,
then so be it. Enjoy. But getting back to, again, what we're talking about with big bets. So again, the market's run up.
I'm sorry to interrupt you. Before you move on, I wanted to ask you, do you play any fantasy sports?
I play fantasy football with my wife's family just because they needed a fill-in.
Okay.
So, but normally
I was going to ask you if you would consider that to be sports betting.
Oh, there's no money involved.
Okay.
So I think there has to be money involved, but there's no, in ours it's free. I think it's just for fun.
I was just curious.
But yeah, do I consider that? No. I think when you have a lot of people do Super Bowl pots or things like that. I think if you're betting on an outcome of a game against a house, kind of like a casino.
Yeah.
But if you're playing poker with your buddies, I guess that's technically gambling. But to me personally, I don't see those as the same things.
Just curious.
Yeah. What about you?
Yeah, I think I feel the same way. I play fantasy football and actually baseball too. I know it's kind of a dorky thing.
You pay for big money, don't you?
Not big money, but there is money involved. It's not a lot, but it's usually...
Do you consider that gambling then?
No, I don't.
Right. I think if there's a house involved, so Harrah's, it's you against Harrah's is different than you against 10 of your buddies.
Yeah, there's no house that gets any money. It's whoever wins. Right. So anyway.
I think that's different. Anyways.
All
right, so switching gears. All right, so this is a financial show. So we'll get into the actual financial part of it. So again, the market's run up. Again, the S&P 500 is up over 20% as of the recording of this show, roughly double what it typically averages. So what is the average investor to do with their 401k? Do they just let it ride and do they double down? Or is now the time to rebalance? What would you suggest? And again, we're not giving financial advice here. Ultimately, you need to have a one-on-one conversation with your advisor. But broadly speaking, what do you think?
In my opinion, the prudent thing to do is to know what your target blend of stocks and bonds is. And if that's gotten out of balance, rebalancing yourself back to that. In other words, let me give you an example. If I'm younger, right? I plan on working a long time. So the vast majority of my money that's invested is invested in the market.
Okay.
So let's say that's 80 or 90% of my overall portfolio. If 80's grown to be 90 or 90's grown to be 95, take that money that you've made and rebalance it and move it back over onto the fixed side, basically locking in those gains. But I think if you don't have a target blend and you've never really given that
right,
any
because most
thought,
people don't.
now is as good a time as any to say, okay, how should I be set up? If I need to get a little bit more conservative, there's no better time to do it because the market's up 25% and it's hitting all-time highs.
It's a very good point. And if you're watching this or listening to this and you don't have a target blend, don't hesitate. Reach out to Falcon Wealth Advisors. You can find us on the internet, falconwealthadvisors.com. Certainly reach Cory and I on the social media platforms. Let's set up a meeting. Let's mock up a financial plan and let's create a target. That's a really good point because if you don't have one, what do you rebalance to?
Right.
And that's kind of like... And to go back to our making big bets, if you go into casino just trying to get rich, right? You have $100, you have $1,000, whatever it is, and you're just going to try to shoot the moon and get as much as you can. That's okay maybe if that's your entertainment, but your retirement shouldn't be in your entertainment bucket.
No.
Meaning you shouldn't have your investments just out there trying to make the most possible because you could end up doing some serious damage to your longer term goals, and that could cause you to work another decade or never be able to retire.
Right.
And maybe that's okay. Maybe some people don't want to retire, but if you do want to retire, or most importantly, if you want to be financially independent, then to us, it makes a lot of sense to have first and foremost a financial plan, which should dictate a target blend of stocks to bonds. And then that's what, to Cory's point, you can rebalance to that when you do have good years. And I agree with you. So again, even though on an individual basis, because we buy individual stocks, we're doing that even a little bit more micro. So even if just an individual stock has gone up, we're rebalancing that stock into other stocks that maybe haven't as performed as well. So
correct.
What you're saying is a bigger level, stocks to bonds. What I'm saying is even on a micro level,
more granular
within your stocks, maybe some of your stocks are up 50%, right? Well, maybe you should sell not all of those shares, but maybe you should sell some of those shares and go in and put into a stock that maybe hasn't done as well, that you think may do well. And again, that's why people hire us. Our clients, again, they don't expect to go do that on their own. We're doing that on a discretionary basis with certainly a fiduciary mindset involved with that. So the idea is that we're only acting in their best interest when we do these things. And the whole idea is that we want to make money and we want to capture it versus making money and then just watching it go down. Because inevitably the market will go down.
Correct.
Right? It never has stayed down, right? It's, knock on wood here. It's never gone down to zero, but it does go down, right? Recessions do happen. Pullbacks are completely normal. And you certainly don't want to see your account go up and then ride it all the way down and then you didn't do anything to capture that. So this is a horrible analogy, but it's almost like taking some chips off the table, right? So if you win a big hand of blackjack or poker or whatever that is, take those chips, put them in your pocket, right? Save them from a rainy day. Take out your spouse to a nice dinner or go on vacation, right? Versus leaving them all out there and risk losing them all. Don't treat your retirement like you're at Harris.
You're right.
And I think a lot of people do. And I don't.
Of course.
And I don't know if it's greed or fear or emotions, or maybe they just don't know, right? And I think that's a big part of it. They don't know what else to do. They've been trained to save their money, which is what they're doing, but they're not looking at their investments on a daily, monthly, quarterly basis like we do for our clients. And so if you don't know any different, why would you rebalance?
Right. I think the psychological fallacy that's in play there is, if somebody does treat it a little bit like a casino or like they're gambling and they get a few things right, that leads you to believe, well, I'm really good at this.
Yes. Overconfidence is a really big thing and you have to be careful.
I mean, I know you see it. I certainly see where clients they'll come in to meet, they'll describe themselves as conservative. They don't live high on the hog. They don't live a crazy lavish lifestyle. Their whole approach is conservative, and then in their investment portfolio, it's 100% one stock. It's like that goes against basically everything you just used to describe yourself. Right. So it's just figuring out how to align those two, I think.
That's very good. That's a good point. So aligning your values to your portfolio.
Yes. And your lifestyle.
Yes, makes a lot of sense. Now, ultimately, again, we enjoy years like this and we certainly want to make money.
Of course.
But we don't want to lose it either. So we just want to be very prudent. And that's what we're doing for our clients right now. So we're rebalancing within their stock portfolios. And then if their stock to bond allocation is off, we're rebalancing that as well. We typically use a 5% threshold. That's what you and I learned from the University of Pennsylvania's Wharton School. And that's what typically we use as a guide. So we don't do it based on time. We do it based on the mathematical allocation. right? And that's to us, that's more important than just doing it periodically. You want to do it based on, in our opinion, based on fluctuation. So if your advisor is not doing that, or they haven't talked to you about that, that's something definitely that you might raise a red flag to. And if you're managing it on your own, you definitely want to go take a look at your 401k and maybe do some rearranging back to your target. And then most importantly, if you don't have a target, that's when you call Falcon Wealth Advisors, and we can help establish one, create a financial plan, and make sure that you're capturing those gains in the most efficient manner.
Agreed. I wanted to ask you that. What's your opinion on, there's a lot of people that look at fundamental analysis. There's a lot of people that look at technical analysis, right? So people that just evaluate basically on a chart what the market's done and make a determination of, well, if there's a lot of strength that precedes more strength because things have gone up so much and they've sort of broken out above certain levels that they'll continue to move up. Do you give that any thought?
Yeah, let me define those real quick for people that may not have heard those terms. So what Cory's referring to is technical analysis, like he alluded to, is literally looking at a market chart. So a stock has a past performance and looking at what it does and literally using that pattern to make your investment decision. Fundamental analysis is looking at who the CEO is, corporate earnings, what products they make,
free cash flow,
revenue, right, debt, all of those things. I personally feel that the charts or the technicals drive the market in the short term, but the fundamentals drive it in the long term. And when we're making decisions on our stocks for our clients, we far outweigh the fundamental strategy versus the technical. So we don't ignore the technical analysis, but we definitely look at the fundamentals and let that carry more weight.
Yeah.
So I don't know if that answers your question, but I think
curious.
fundamentals more important.
Sure.
When I was studying many years ago for my Series 7 and it talked about technical analysis, I laughed. I was like, this is a joke. Are you telling me some silly chart is going to dictate what Microsoft stock's going to do? Doesn't that seem a little absurd to you?
A little bit.
Right? When you have real people running a company, real earnings, right? Real products, or McDonald's or Google. You're telling me a squiggly line is going to tell me which direction the stock's going to go?
I think it more pertains though to, I do think there are some people out there that do make careers as traders and using
based on charts. Yeah, but I think
they're not looking at the long term.
True, which is different than us, right?
Totally different.
For our clients, stocks are in their portfolio for a very specific purpose, and that's to grow their capital above inflation for a long time.
Yeah,
Good
exactly.
point. But again, I would argue those traders are just trying to justify their gambling habit.
Maybe.
Because it's the same thing. I mean, you look at a roulette wheel and it's they spin it around and maybe it's hit on 10, 20 times. Does that mean it's going to hit on 10 the next round any more than the previous? No, it doesn't, in fact. Right? But so what these traders are using is this chart saying it went up, but does that mean that past performance is any indicator of the future? It doesn't.
No.
So again, I'm not a big fan of these.
I'm just curious.
These short-term trades.
I think you can make the argument could be made though. It's the same thing with, even if you're looking at the long term, right? There's nothing.
No, and nobody can predict the future. I get it, but if you have a CEO with a vision and employees that are amazing and R&D,
I agree.
But so you have real people running these companies. To me, that means a lot more than some stupid chart. Yeah. And maybe that's just me.
Well, you're investing, not trading. Two different things.
Yes. And again, you're right. It's a huge industry. There's a ton of people, and they're probably way smarter than me using these charts and trying to make money. But again, I would argue that they're just gambling.
Yeah.
And I don't think fundamental analysis is gambling. I agree that you can't predict the future, but if we know who the CEO is of XYZ company, and we know what their vision is and what their goals are and what they're trying to do and their free cash flow and all of those things, to me, that's making an informed decision.
Right.
Looking at a squiggly line, I don't know.
I don't know how many charts Warren Buffett uses.
Right. Good point. That guy reads a ton. He reads all day long, and I think he's done pretty well.
Yeah, he has.
Right? And I don't think he's a chart guy, is he?
I don't think so.
No, I think he buys low and he sells high. Pretty smart.
Pretty smart, right? It's that easy.
It's pretty smart. So anyway, so
I just wanted to bring that up.
No, thank you, and that's a little bit. I feel a little bit passionate about that because I don't.
I see that.
Yeah, I just don't. I'll never forget reading the book. I was reading the book and I was like, really, this is actually a real thing. Like, this isn't a joke. That people are really doing this technical analysis and making it and talking about double tops and double bottoms or whatever all that terminology is they use. It's like, this is a joke, in my opinion. So we don't do it. Unless you don't want to do it, do you?
No.
Well, that's good. That might be a topic for another show if we disagree that much. Because again, I think the fundamental analysis is more important. So a big takeaway is the prudent thing to do is we've had a heck of a 2019. Very thankful for that. But you don't want to just let it ride, right? So don't double up at the craps table or the blackjack table with your 401k. Be prudent, rebalance it. If you don't have a target, establish a target and do the right thing. It's been proven that if you can get that more consistent return, that's going to help your financial plan play out that much more solid. If you get overweight stocks, you're increasing your risk, which increases volatility, which could potentially harm your financial plan. And you want to be careful of that.
I think that's going to be just more of a challenge over the last decade as the market's done well. I think now is a great time to reevaluate risk.
Do you think they're forgetting 2008? I don't think they are. But do you think investors are you think that's been 10 years removed and they don't remember how painful it was?
I think they remember how painful it was, but I think each and every year that passes, and the further away that it gets, people just tend to forget a little bit more. People forget about what the other side of things feels like.
That's true, and that's natural. I mean, we can't help that as humans.
Yeah, right?
We can't help that as humans. But that's interesting because there's also been talk that millennials are far too conservative because they grew up in that '08 era,
right,
and they don't trust the stock market.
Yeah, no, I was talking to my brother about this last night. Actually, I said, if from peak to trough, if the drawdown was 57%, I think
something around that, yeah,
in the financial crisis and the S&P 500, if you had $1 million invested in stocks, you watched it go from $1 million to below 500,000 in 18 months or less.
Yeah, pretty quickly, yeah. But now it's up 300%.
Exactly.
So if you just would have wrote it out, your 500,000 would now be worth what, 2 or 3 million, maybe?
Yep.
Depends on how you had invested, of course.
And if you're rebalancing and you're selling high and buying low.
Right, and if you stayed invested, because that's another big problem.
The hard part.
Is you've got to stay in the game too. I mean, if you need to hit 6%, 7%, 8% for a target, you can't be cashing in everything either and just sitting on cash because historically bonds and cash don't make 7 to 8% over the long term. So again, that's another side of this coin is that absolutely, we're recommending taking some money out of the stock market, but you don't want to take it all out either, because we could follow up 2019 and 2020 could be up another 20%. Right? There's nothing saying that could not happen.
Pop quiz: do you know, going back to 1928, what the average return for the S&P 500 is during an election year when the sitting president is running for re-election? I don't expect you to know the answer to this.
Oh, this is a good one though. So.
Since
1928, when the incumbent is going for, because I guess sometimes because if they
2 terms.
Yes, I gotcha. So when it's a potential for an incumbent to win, what is the average return since 1928? I don't know. What is it?
It's 12.8 or 12.9.
Nice, so above
total
average.
Return. Mm-hmm.
Now, isn't there studies too that if the incumbent wins, doesn't the market typically do better than if somebody else?
I believe so.
I
I'm
read
not
an article
entirely
on that
sure.
the other day.
I just thought it was interesting that going back to 1928, when the incumbent's running for re-election, the average total return is 12.8 or 12.9%. When there is not someone running for re-election, the average total return is like 4.5%.
Wow. You know why?
Uncertainty?
Exactly. Yeah, that's a big one. So the idea is whether you like Trump or not, and we tried to solve politics on one of our recent shows.
I don't think we did.
Whether you like Trump or not, the idea is that at least that's a known entity.
Yes.
And the market already has had 3 years so far of it. So if he were reelected, there would be probably much more of the same. Versus when you go in and he can't be reelected, well, now you have 2 unknowns.
Yeah, who knows, right?
Yeah, so you're just doubling up your uncertainty, and the market hates uncertainty. That's the number one thing, in our opinion, that drives volatility is uncertainty.
But for me to bring that back to your point,
fact,
where you were getting though is, at the end of the year, the market's done great. If you said, I'm going to sell all my stocks because things have done well, and let's say next year is one of those average years and it's up another 13%.
Right, not a good idea.
Done that.
Yep, exactly. And that'll also do damage to your financial plan too.
Yep.
Good. So this was a good little rant, a little back and forth today. So again, the takeaway of the show is don't make big bets with your 401k. And don't do it alone, right? Talk to a fiduciary-minded advisor. We prefer independent advisors. We think because we don't have to answer to any corporate agenda, we can give you our opinion as it plays out and versus what our boss is telling us to do. as ultimately we only like answering to our clients.
Yep.
So, all right, very good. So that's all the time that we have for today. We've already done kind of some plugs to our show, but again, thank you for watching this. If you're watching it on YouTube, please subscribe to our channel. We're out there on all the podcast mediums, or most of them. Spotify and iTunes, I know, are a couple of big ones. And certainly if you're out there on Twitter, I don't have a lot of Twitter followers, but if you want to follow me, my Twitter is Jake Falcon CRPC.
My Twitter handle is @Cory Bittner KC.
Perfect. Thanks again, and we hope you all have a great week.